Should you sell your Amazon RSUs? So with Amazon stock down by almost a third this year through late May, I think this question is particularly relevant right now. And I look at it kind of from two perspectives. First is my generic advice to anyone with RSUs. And then second is kind of looking at the attractiveness of Amazon stock today. So I think the generic advice I have for people with restricted stock units and their employers is to sell their shares as soon as they vest. It's basically taxable as income the second that those shares vest. So there's no additional tax impact to selling the shares at that point. And so I think the way you should kind of frame that decision is you should think of those RSUs as a cash bonus. And then the decision to hold on to them should really be thought of as an active investing decision to put money into your employer's stock. Now, you're already tied into your employer's future fortunes via your salaries, future bonuses, future RSUs, any increases in the future. And, this has historically worked out. There's been some disaster cases, things like Enron, where it was a high-flying stock and employees put all their money into it, and then not only did they lose their jobs, but they lost their life savings when it went bust. Not that that's a huge concern with Amazon, but there are horror stories out there, and we want to mitigate risk. So the other aspect, though, is looking at the attractiveness of Amazon stock today. Now, because anytime I think you're investing in your employer, you should have a much, much higher hurdle in that investment. You should be really confident that those shares are significantly undervalued. Now, how do you do that? I think you have to put a lot of time and effort into investing. Again, this is an active decision. So unless you are really passionate about investing and you put a lot of time into learning about it and researching and really come out with a well laid out thesis for why the stock is undervalued, it's something I think that most people should avoid. So with that as kind of a warning, we'll look at the stock itself. So I'm a CFA charter holder, I'm a CPA, I love investing, I'm passionate about it. I usually do more value investing, so I'm looking for things that I think are worth $1 that are trading at 50 cents, cheap on cash flow, sales, assets, etc. Amazon's definitely more in the growth profile, so it doesn't fit my normal wheelhouse, but let's check the stock out anyways. So on the surface level, not surprisingly, its current valuation looks expensive relative to a lot of stocks, but not surprising given its growth profile. So Amazon's about 2.4 times sales, price earnings around 54, a little under 20 times enterprise value to EBITDA, earnings before interest, taxes, depreciation, amortization. So all those are a little bit on the high side. If you stack that up relative to, say, other retailers like Costco, Walmart, it's definitely more expensive, but it's had better growth, so that's not super surprising. If you compare it to, say, other tech companies, it does look more expensive as well, especially not so much on sales, but Amazon has lower margins. But on an earnings basis, Amazon does look more expensive. I think probably the most important factor in looking at Amazon would be its price to sales. Now, reasonable minds can differ as to what the future margins are going to look like for Amazon. If it's going to be more of a retailer, you're talking about profit margins of 2, 3, 4, or 5%. And that's going to, that will demand a much lower price sales multiple. If it is more of a tech company and they can get those profit margins at 10% plus, then a higher price sales multiple would be justified. I do think looking at Amazon's own history in terms of its price sales ratio might be the best way to look at it. So at today's ratio, about 2.4, it's, I'd say about the middle of where it's been the last 15 years. From, say, 2018 through 21, 22, its multiple was much higher. And that was, in my opinion, driven by the fact that Amazon's profit margins started to materialize, going from 0 to 2 for much of its history, and then all of a sudden doing 5 to 7% profit margins. And I think a lot of that's driven by the success of AWS. But then again, if you look at 2008 till, say, 15, it was more like 2 times price sales. Now, I think on the one hand, maybe justifying somewhat of an increase in price sales is those higher multiples. But on the other hand, Amazon's a matured business now. Its margin or its growth going forward is likely to be much lower. Amazon sales grew about 27% compound annual growth rate the last decade. Hard to imagine off of it went from 60 something billion in sales to 400, 500 billion in sales. Hard to imagine it's going to grow at the same rate going forward. And to that point, during Q1, I think Amazon sales grew about 7%, and they're guiding to 3 to 7% growth in Q2. So it's looking like those sales will be much, much lower going forward. And when I look at it, I just have a hard time justifying paying 2.5 times sales for a business that might only do 5-10% profit margins and is only growing at 3 to 7%. So it's hard for me to find any case that it's substantially undervalued, especially given the lower growth profile. I think if you were really bulled up on Amazon, you would be a big believer in its innovation, a big believer that you're going to see really, really substantially higher profit margins in the future, coupled with high growth. So if you think Amazon's going to do profit margins of 20%, if you think they're going to keep growing at 20% in the future, then maybe you would justify a 2.4 times sales type multiple. But if you kind of look at it, what it's historically done, and you think it's going to do more of like a 5 to 10% growth rate the next 5-10 years, I find it hard to find a real path to arguing the stock's undervalued. And maybe more important is that you'd have to argue that it's substantially undervalued if you're an Amazon employee, because you really want a margin of safety. You want to be really confident in that value. So I think my advice for most Amazon employees is the same as it ever has been, which is to sell those shares as soon as they vest. Always happy to discuss your situation or investing in general if you'd like. Anyways, this has been Scott Caulfield with Sophos Wealth Management. Appreciate you guys taking the time. Bye.